Good morning, Doctor. Today, our group will present the analysis financial management of Dutch Lady Milk Industrial Berhad and Nestle Malaysia Berhad. Now, I will present the introduction of Dutch Lady Milk Industrial Berhad. Dutch Lady Milk Industrial Berhad is owned by Friesland Cabinet, one of the world's largest dairy companies. Dutch Lady is a multinational company specializing in the dairy industry. Dutch Lady was established in 1963 in Petaling Jaya, Selangor. Dutch Lady produce a wide range of dairy products such as UHT milk, yogurt drinks, formulated milk powder, and more. Next is trend analysis. Ratio analysis of Dutch Lady in 2021, 2022, and 2023. Liquidity ratio. The current ratio formula is current asset divided current liability. In 2021, the current ratio is 1.58. Then it decreases to 1.12 in 2022 and decreases again to 0.8 in 2023. The quick ratio formula is asset minus inventories and divided by current liability. In 2021, it is 1.1, decreasing to 0.59 in 2022, decreasing again to 0.32 in 2023. Asset management ratio. Inventory turnover formula is cost of goods sales divided inventory. In 2021, it is 7.04, decreasing to 5.85 in 2022, then increasing to 5.98 in 2023. The fixed asset turnover formula is sales divided net fixed asset. In 2021, it was 5.17. It decreases to 3.72 in 2022 and decreases again to 2.67 in 2023. Total asset turnover formula is sales divides total asset. In 2021, it is 1.62, decreasing to 1.59 in 2022 and decreasing again to 1.52 in 2023. Day sales outstanding formula is receivable device average sales per day. In 2021, it is 24.59, increasing to 26.63, increasing to 26.63 in 2022, then decreasing to 23.87 in 2023. Debt management ratio. The debt to capital ratio formula is total debt divides total investor capital. In 2021, it is 44.44%, increasing to 52.22% in 2022, and increasing a little bit in 2023, which is 53.61%. Next is time interest earned formula is EBIT divides interest expense. Time interest earned in 2021 is 84.81, decreasing to 15.42 in 2022, then increasing to 22.08 in 2023.
Assalamualaikum warahmatullahi wabarakatuh. My name is MOHAMAD. So, I will present about profitability ratio. Let's start with the operating margin, which is calculated by dividing EBIT. This ratio shows how much profit the company makes from its operation before interest and tax. In 2021, the ratio is 25.27%. In 2022, 4.21%. In 2023, 6.93%. As we can see, the operating margin decreased significantly in 2022, but shows some recovery in 2023. Next is profit margin, which is calculated by dividing net income by sale. It indicates the percentage of revenue that remains as profit after all expenses are paid. In 2021, the ratio is 21.87%. In 2022, 3.45%. In 2023, 5.02%. Similar to the operating margin, the profit margin also saw a decline in 2022 but slightly improved in 2023. The basic earning power BEP ratio measures the company's ability to generate earning before interest and tax from its total asset. In 2021, the ratio is 40.85%. In 2022, 6.68%. In 2023, 10.56%. The basic earning power show a decline from 2021 to 2022 but improved in 2023. Next, the return on asset ratio indicates how efficiently the company uses its asset to generate net income. In 2021, the ratio is 35.37%. In 2022, 5.48%. In 2023, 7.65%. ROA decreased significantly in 2022 but shows some recovery in 2023. Finally, the return on equity ROE measures the return generated on shareholders' equity. In 2021, the ratio is 64.82%. In 2022, 11.66%. In 2023, 16.56%. Similar to other ratio, ROE saw a decline in 2022 but improved in 2023. Now, let's move on to the market value ratio. Firstly, price per earning ratio. In 2021, the P/E ratio is 8.65% in 2022, 41.9% in 2023, 20.54%. The P/E ratio increased significantly in 2022, indicating a higher valuation by the market despite lower earnings. It then decreased in 2023, reflecting a more balanced valuation. Next, the market per book ratio compare the market price per share to the book value per share, providing insight into how the market value the company relative to its book value. In 2021, the ratio is 1.60%. In 2022, 3.55%. In 2023, 3.83%. The MB ratio show an upward trend from 2021 to 2023, indicating an increase in market valuation relative to the company book value. Next, we will analyze the company return on equity. Using the DuPont system, there are three components: profit margin, total asset turnover, and equity multiplier. This breakdown helps us understand the different factors contributing to the company ROE. In 2021, the ratio is 64.81%. In 2022, the ratio decreased to 11.64%. But in 2023, the ratio increased to 16.57%.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad HAFIFI bin JUMAAT. Today we will be discussing Nestlé Berhad Financial Report. With its headquarters located in Switzerland, Nestlé is a famous multinational food and beverage corporation that is a part of the global Nestlé Group. Nestlé, which manufactures well-known brands like Milo, Maggi, KitKat, Nescafe and Lactogen, has its headquarters in Mutiara Damansara, Petaling Jaya, Selangor. Nestlé Malaysia has a strong commitment to sustainability and social responsibility, which it actively supports through nutrition and education initiatives that encourage healthy living. We will now proceed to the analysis of Nestlé Berhad ratios. There are assets management ratio and liquidity ratios based on the table displayed here. The quick ratio is 0.22 and the current ratio and current asset is 0.61. Pay attention to the asset management ratio. For every 1 ringgit of the assets generate 4 ringgit 3 cents in sales, and every 1 ringgit of total assets generate 1 ringgit 98 cents in sales. Nestlé is also taxed on average 23.97 or 24 days to collect accounts receivable in 2023. Furthermore, the debt management ratio shows that the total debt ratio is 81.09%, meaning that 81.09% of assets have been financed by debt. The time interest earned ratio shows that for every ringgit of interest, the company has 50 ringgit 48 cents of operating earnings available to pay. According to the operating margin and profitability ratio, the company generates 13 ringgit and 32 cents EBIT for every 100 in sales. The profit margin then reveals that the company makes 9 ringgit 4 cents in profit for every 100 in sales. According to the basic earning power profitability ratio, the company's EBIT is 26 ringgit 32 cents for every 100 in assets. According to return on assets, the corporation makes 80 ringgit 15.7 cents for every 100 in assets. According to return on equity, the company makes 98 ringgit 23 cents in net income for every 100 ringgit in common stock funding. Finally, this table displays Nestlé Berhad's market value ratio, where the market book value ratio indicates that investors are willing to pay 2 ringgit 49 cents for 1 ringgit of the book value of stock. The price earning ratio indicates that investors are willing to pay 41 ringgit 79 cents for 1 ringgit of earnings. According to Nestlé 2023, the point system, for every 100 in sales, the firm makes 9 ringgit 40 cents in profit, and for every 100 in assets, it can make 198 in sales. The business makes 98.45 cents in net income for every 100 invested in equity financing in 2023.
Next, 540 comparison of ratio in 2023. 5.1 liquidity ratio. First, for the current ratio for Dutch Lady is 0.8 and for Nestlé is 0.61. The ratio show that ability to cover current liability with current asset. A value below 1.0 suggests that the company may not have enough short-term asset to fully cover their ability. Dutch Lady performs slightly better than Nestlé, but both have no low current ratio. Next, for the quick ratio for Dutch Lady is 0.32 and for the Nestlé is 0.22. The quick ratio is a slightly measure including inventory from current asset. Both companies have very low quick ratio, indicating potentially liquidity challenge. Dutch Lady again has a slightly higher ratio, meaning it is in a better position to handle short-term liability without rely on inventory. So both companies show weak liquidity position as their ratio are below the benchmark of 1.0. Dutch Lady is in a relatively better position than Nestlé in terms of liquidity, but the low value for both the current and quick ratio signal potentially risk in meeting short-term obligation. 5.2 Asset Management Ratio. Asset Management Ratio for Dutch Lady and Nestle in 2023. This ratio evaluates how effectively a company utilizes its asset to generate revenue and manage operation. Ratio in the table. Okay, first, inventory turnover, Dutch Lady 5.98, Nestle 8.48. This measure how many times inventory is sold and replaced during a year. A higher ratio indicate effectively inventory management. Nestle perform better, turning over inventory more frequently than Dutch Lady. 2. Fixed asset turnover, Dutch Lady 2.67, Nestle 4.03. This show the effectively of generating revenue from fixed asset like building and equipment. Nestle again outperform Dutch Lady, indicating better utilization of its fixed asset. Okay, next 3. Total asset turnover, Dutch Lady 1.52, Nestle 1.98. This measure how effectively the company generate revenue from total asset. Nestle demonstrate higher effectively compared to Dutch Lady. 4. Days sale outstanding, DSO, Dutch Lady 23.87 days, Nestle 23.97 days. DSO indicate the average number of days it takes a company to collect payment from credit sale. Both companies are similar in their collection effectively, with Dutch Lady being slightly faster. So Nestle showed better performance in inventory turnover, fixed asset turnover and total asset turnover, indicating stronger operation effectively. Both companies have similar DSO, suggesting they are equally effective in collecting receivables from customers. 5.3 Debt management ratio for Dutch Lady and Nestle in 2023. This ratio assesses how effectively a company manages its debts and its ability to meet interest obligation. Okay, first debt ratio for Dutch Lady 53.61% and Nestle 81.09%. The debt ratio measures the percentage of a company assets financed by debts. Dutch Lady has a lower debt ratio, indicating lower finances risk compared to Nestle. On the other hand, Nestle relies more heavily on debts to finance its assets, which increased finance risk but could potentially lead to higher return if the borrowed fund utilized effectively. 2. Time interest earning ratio, TIE time. Dutch Lady 22.08, Nestle 50.48. The time ratio shows how many times a company can cover its interest obligation with its earning before interest and tax, EBIT. Dutch Lady has a higher time ratio, indicating a stronger ability to meet interest expenses compared to Nestle. This reflects a more stable finances, potentially in terms of this cost management. Dutch Lady demonstrate a more conservative approach to debt management with a lower debt ratio and a higher ability to pay interest expenses. Nestle relies more on debt financing, which increase financial risk but could potentially drive higher growth if management effectively. However, its lower tight ratio suggests less room to manage interest obligation if earning decline.
For comparison of ratio, okay, we start from profitability ratio. The Dutch Lady is 6.93%. Dutch Lady has an operating margin which suggests that it keeps about 6.93% of its revenue as operating profit after covering the cost directly associated with producing and selling its goods. This is relatively modest and indicates that Dutch Lady operational efficiency may be lower compared to Nestle, but Nestle is 13.32%, is nearly twice as high as Dutch Lady. This suggests that Nestle is significantly more efficient in generating operating profits from its sales, likely due to better economies of scale, pricing power, and operational efficiency. For profit margin, Dutch Lady has 5.02%, which means that for every dollar of revenue, it generates about 5 cents of profit after all expenses. This is lower compared to Nestle, suggesting that Dutch Lady's cost, taxes, and interest might be higher, or it has pricing power to retain profit from sales. And Nestle is 9.4%. Okay, profit margin, meaning it generates almost double the profit from each dollar of revenue compared to Dutch Lady. This indicates that Nestle is more efficient at managing its costs and retaining profit, possibly due to stronger brand equity, cost control, or higher pricing power in the market. For basic earning power, Dutch Lady basic earning power is about 10.56%, means it generates a modest return on its asset before paying interest or tax. This suggests that Dutch Lady's assets are reasonably efficient at generating earnings, but there is a room for improvement in asset utilization or operational efficiency. Okay, for Nestle is 26.32%. Okay, Nestle is significantly higher, suggesting that it generates far more earnings from its asset compared to Dutch Lady. This high basic earning power indicates that Nestle is much more efficient in generating profits from its total asset base, reflecting better operational performance, economies of scale, and possibly a more asset-like business model in certain segments. For return on asset ROE, Dutch Lady is 7.65%, suggests that for every dollar of asset, the company generates about 7.65 cents of net income. This is relatively moderate and indicates that Dutch Lady may not be using its asset as efficiently as Nestle in terms of generating net income. For Nestle is 18.57%. Okay, is significantly higher, meaning it that generates nearly 18.6 cents of net income for every dollar of asset. This indicates excellent efficiency in utilizing its asset to produce profits and suggests that Nestle is much better at managing its asset base, likely leveraging its brand, operational efficiency, and global scale. For return on equity, which is ROE, Dutch Lady is 16.56%, which means that indicates that it generates a solid return on its equity. This suggests that Dutch Lady is effectively using shareholders' equity to generate profits, but its ROE is more modest compared to the Nestle, possibility due to less leverage or lower profitability. Okay, for Nestle is 98.23%, which is extremely high, suggesting that Nestle is very effective at generating profits from its equity base. But this could be due to strong profitability, financial leverage, use of debt, and efficient asset utilization. Nestle ROE is likely amplified by high profit margins and better asset turnover, making it much more efficient in generating returns for shareholder. Okay, for price earning, Dutch Lady's price is 20.45, is extremely high, suggesting that investors are willing to pay a very high premium for each dollar of earnings. Okay, this could reflect high market expectation for the company's future growth potential. Okay, it might also indicate that Dutch Lady is in a growth phase or has a strong prospect despite its current earning is being relatively modest compared to its stock price. While Nestle price earning is 41.79, while still high, but is much lower than the Dutch Ladies. Okay, this suggests that while Nestle is also seen as a growth-oriented company, its growth expectations are more moderate compared to Dutch Lady. A lower price earning could imply that Nestle market price is more aligned with its current earnings, or the market is more conservative about its future growth. For market book ratios, Dutch Lady's market of 3.83 suggests that the market values the company at almost 4 times its book value. This could indicate that investors have high expectation for Dutch Lady's future growth and performance, likely because of a perceived ability to generate high returns or outperform its assets in the future. Okay, for Nestle, the ratio is 2.49. It is also greater than 1, but lower than the Dutch Ladies. It suggests that investors still expect growth and profitability from Nestle, but at a more moderate level. The lower ratio compared to Dutch Lady could reflect a more stable, established company with lower growth expectations compared to Dutch Lady. Dutch Lady ROE for the system is 16.57%. A relatively good ROE indicates that Dutch Lady is generating a decent return on its equity. This could suggest that the company is effectively managing its costs and generating profit relative to its equity, but is not leveraging as much debt or operating as efficiently as Nestle. While Nestle ROE is 98.45%, which means that Nestle exceptionally high ROE suggests that the company is either leveraging its equity significantly, using debt, has an extremely high profit margin, or has excellent asset utilization. It may reflect a combination of strong global branding, efficient operation, and high profit margins, possibly coupled with financial leverage. Okay, Dutch Lady likely has a lower ROE because of a combination of moderate profitability, less efficient asset utilization, and a conservative approach to leverage. While Nestle, on the other hand, has an exceptionally high ROE because of a higher profitability, larger profit margins, better asset turnover, more efficient use of asset, and potentially higher leverage use of debt to amplify returns. Okay, for conclusion, to improve its financial standing, Dutch Lady should focus on enhancing its liquidity by increasing its current and liquid ratios through better cash management, reducing liabilities and optimizing its inventory. Improving asset efficiency, particularly in inventory management and fixed asset utilization, will be key to boosting performance. Additionally, Dutch Lady could work on increasing its profit margins by controlling costs and implementing pricing strategies to enhance profitability. Expanding into a new markets or product categories and emphasizing sustainability could also help the company meet investor expectation and fuel growth. Finally, balancing its use of debt and equity financing will allow Dutch Lady to maintain financial flexibility and support growth without taking on excessive risk. By addressing these areas, Dutch Lady can improve its financial performance, close the gap with Nestle, and enhance its competitive in the market. Thank you so much.